Hey everyone, Troy Evans with ChL&x. In this video, I want to help you be better prepared to shop your mortgage quote when you're getting your next home loan. Shopping for the best deal in everything we do is something that we all want. For some things, that's easier said than done. And unfortunately, when you're shopping your mortgage, oftentimes that's the case. It should be said as a mortgage loan originator that I don't have a problem when a borrower wants to shop their deal or get multiple quotes and compare them. Maybe that's just because I'm a nice guy. Maybe it's because I know how sharp my rates and fees are compared to my competition, but whatever the reason, I don't believe that anyone should pay a ton of extra money up front or higher interest over the life of their loan just because. And lastly, it should be known that as much as the regulators have worked to unify the mortgage industry and have us using the same formats, naming fees the same, etc., there's still a ton of differences lender to lender. You as a borrower might reach out to 3 different lenders, and if a formal application wasn't made, you may receive a quote back in 3 different formats. That becomes very difficult for you as a borrower to know how to shop your best deal. And lastly, is the interest rate and fees all there is to a mortgage loan? Absolutely not. I'd be doing a large disservice if I didn't at least acknowledge the immense value in getting your loan done smoothly, getting your loan done on time, and getting your loan done without any surprises. If you're buying a home and you have a very short deadline with the seller and the cheapest offer that you have can't execute that quickly, does it even matter? No. The loss you'd experience by using a lender or a loan officer that can't work within your deadlines is in many cases even larger than what you're hoping to save by using that lender. There are a few things that I think a borrower should know about mortgage rates when you're working to shop your loan. I'd like to go over those first. Number 1, what makes up a mortgage rate? There is the rate itself. This is the note rate that the monthly payment is calculated off. Then there is the dollar cost of any given rate. There may be a cost in the form of a discount point or buying points up front, or you may have a rebate in the form of a lender credit. Lenders are able to offer these rebates because the interest collected over time. So think of it this way: the higher the interest rate and thus the higher interest paid over time, the higher the potential rebate. On the flip side, the lower the rate and thus the lower interest paid over time, the higher the cost. So 2 things make up a mortgage rate: the note rate itself, which is what your monthly payments are based off of, and then there's the cost of that associated mortgage rate. Second is how often can rates change? When a borrower receives a mortgage from a lender, the lender will wait until they have multiple loans that are very similar and then package them all together to form a bond. These groups are then sold on the bond market. The price of these bonds on the bond market, and specifically since we're talking mortgages, that's called the Mortgage Backed Securities bond market, that is single-handedly the largest factor in determining mortgage rates. These bonds are purchased and sold by investors all day. As these bond prices move up and down, it causes the mortgage-backed securities price to be reflected in mortgage rates. These can change quite frequently. Let's tie this together with our earlier point to make an example. If a 6% rate, as shown here as an example, involves neither an upfront discount cost nor a rebate from a lender, then a 5.75% interest rate may have an upfront cost, again, simply a sample or an example, of an upfront discount point that would be associated with buying that interest rate down. A 6.25% interest rate wouldn't have any buy down points up front, but could have a lender credit that could be used to offset your other costs. So this part, the cost, is almost guaranteed to change daily. And in many cases, it may even change multiple times throughout the day. So how often can they change? Quite frequently. Generally, they'll change day to day. Sometimes they may even change multiple times within the day. Third thing is, what is a rate lock? A lock means that there's an agreement between the borrower and the lender regarding what the contract rate will be. The rate lock will also specify a date by which the mortgage must be closed and funded. A shorter lock term can result in a better rate for you, the borrower, but it's very critical that you understand the duration of your lock. Because if you fail to close your loan before your lock expires, it could result in very expensive fees to extend your lock, especially if interest rates have gotten worse. So now that we've got those housekeeping items out of the way, I want to dive into the deeper part, which is probably the reason you're here: how to shop your loan. It's very important when you're getting your mortgage quotes that you compare apples to apples. What does this even mean with the mortgage? Well, it can be simple. You should request your quotes with the following: the same program. you'll do yourself a lot of favors comparing quotes for the same loan programs. Getting one quote for a 15-year loan and trying to compare it to another that's a 30-year loan is useless. Or one quote with a conventional loan and another with a VA loan. It's not going to be very easy to compare quotes and decide which one's the better deal lender to lender. So always make sure that you're comparing quotes that are using the same program. The second thing, make sure that your quotes are using the same loan parameters. Do you have to have your credit pulled or go through the entire pre-approval process before you're even able to get a quote? No. But it's important that you provide the same loan parameters to your prospective lenders. This could include things like credit score, your loan amount, your purchase price and down payment, the property type, the lock duration, the occupancy type, whether it's a primary residence, a second home, an investment property, things like that. So always make sure that you're getting your quotes using the same loan parameters. Third is make sure that they're always prepared at the same time. Remember earlier in this video when we talked about how frequently rates can change? Because of that, it's very critical that you get your estimates at the same time, on the same day at a minimum. The next thing is make sure that you're comparing those quotes using the same interest rate, that note rate that your monthly payment is based off of. Now that you've got multiple quotes that are using the same program, that are using the same loan parameters, that are prepared at the same time, that are using the same interest rate, you'll easily be able to compare the difference in lender fees. What do I mean lender fees? There's a difference between lender fees and non-lender fees. There's a number of other settlement costs that may also appear on a full quote or a full estimate, but many of these are not controlled by your lender. You're going to want to compare the lender fees and see what each lender is charging you for that specific interest rate on that program. As I said earlier, despite the best efforts of the regulators to get mortgage quotes in the same format, you may get them in multiple different types of formats. We've developed an easy-to-use sheet to quickly compare side-by-side multiple different lenders and multiple different quotes. Also be able to determine what's a lender fee and what's a non-lender fee. So reach out today if you'd like help with this. Be happy to show you that sheet, and hopefully using these tools and these tips, you're able to better prepare yourself to shop for the best deal on your next home loan.